Hi everyone, welcome back to Trading Made Simple, the series where we break down the world of trading step by step. I'm Ahmed, and in today's episode we're going to be talking about contracts for differences, or CFDs. CFDs are one of the most popular trading tools, essentially for beginners who want flexibility in the markets. So what are they, how do they work, and what are they different from traditional investments? Let's dive right in. Imagine this, you want to trade gold, but you don't want the hassle of owning physical gold. That's where CFDs come in. A CFD is a financial contract between you and your broker. Instead of owning the actual asset like gold, stocks, or oil, you're trading based on the price movement of the asset. If the price goes up or down, you either make a loss or a profit, depending on your position. For example, if you think the price of gold will rise, you buy a CFD. If you think it'll fall, you sell a CFD. It's that simple. But here's the key. With CFDs, you never own the actual asset. You're only trading the difference in its price from when you open to when you close your trade. So how do CFDs work? Now let's break it down step by step. First up, you choose an asset. CFDs allow you to trade a variety of assets, such as forex pairs like Euro USD, commodities like gold, silver, or oil, indices like S&P, and sometimes even cryptocurrencies. Next up, you decide your position. If you expect the price to rise, you take a long position. If you expect it to fall, you take a short position. Your profit or loss is based off of how much the price moves in your favor or against you. For instance, if you buy a CFD on gold at 1900 and sell it at 1950, your profit is $50 per unit minus any fees that the broker might charge. So how are CFDs different from traditional investments like buying stocks? Let's take a look. Ownership. With stocks, you actually own a piece of the company. With CFDs, you're only speculating on price movement. There's also leverage. CFDs let you trade with leverage, meaning you can control a much larger position with less capital. For example, with 10x leverage, a $1,000 deposit gives you $10,000 worth of trading power, but leverage magnifies and losses both. Next up is flexibility. CFDs let you trade in both rising and falling markets, so you can profit even when prices are dropping. There's some costs. Instead of paying full upfront costs like in traditional investing, CFDs often involve fees like spreads, commissions, and swaps. So why do traders love CFDs? CFDs offer a variety, giving you access to a wide range of markets from one account. Leverage helps you amplify your exposure with smaller capital. The ability to take profit from falling markets through short selling is a significant advantage over traditional investments. Additionally, CFDs don't have an expiration date like options or futures, meaning you can hold your position as long as you want. However, it's important to remember that CFDs come with risks too. Leverage can amplify losses just as much as profits. It's essential to trade responsibly. Now let's explore the markets available for CFD trading. Forex, this is the most traded in the world, featuring pairs like Euro USD, Aussie USD. There's commodities, you can trade silver, gold, crude oil, which is great for diversifying your portfolio. There's indices, you can trade major markets like NASDAQ, S&P, Dow Jones. You can trade some cryptocurrencies, you can speculate on Bitcoin and Ethereum. Shares and ETFs, you can buy some stocks and shares and speculate on the price movement of companies like Apple, Amazon, and Tesla. So there you have it, a complete introduction to CFDs. They're versatile and accessible and offer incredible opportunities for traders, but with great opportunity comes great responsibility, so manage your risk. In the next episode, we'll talk about CFD brokers and how to choose the right one. Don't forget to like, share, and subscribe to stay updated on this series. If you're ready to explore CFD trading, head over to our website, thebcr.com, to learn more. See you next time.